As I discussed in my Investing Terms Part 2 video, net present value, or NPV, means to convert all the future cash flows into today's dollars, which even for me is still a bit confusing way to understand it. For a quick recap on how we calculate this figure, let's look at a simple example. If you buy a property for $1 million and make $100,000 a year, every year for 5 years, then sell the property for $1 million again at the end of year 5, your internal rate of return will be 10%. To explain this simply, you've made 10% on your money every year for the last 5 years since you bought and sold the property with no profit. But what is your net present value? Well, your NPV can only be determined by you as an investor. As an investor, you need to have an idea of what kind of return you're okay with making. For example, if you place your money into a savings account, you know that tomorrow, next year, and even 10 years, your money is still going to be there. Even if the bank closes, so long as you have under $250,000 in your account, the federal government will guarantee that your money is safe. Because of the safety factor, the bank in return pays you a very, very small return rate, usually 0.5 or 0.25%. Because of the lack of risk and the extreme safety of your money, your NPV is under 1%. Safety is your goal. If you're willing to go into a decaying market where unemployment is extremely high and the population is shrinking, you may be demanding a higher NPV. If you're looking into investing into a strong market where there's low unemployment and the population is growing, you may be demanding a lower NPV. Let's look at a real-life example in my market area. San Francisco is currently, and almost always has, been considered one of the most top invested locations in the United States, along with places like New York, LA, and other large metro areas. Because many people view it as a stable investment, they're willing to accept less of a return, typically right now in the 3 to 6% range. Right outside of San Francisco are some pretty stable locations which aren't considered as great as San Francisco, but are fairly close to investment value. In locations such as Berkeley and downtown Oakland, your average return range may be 5 to 9%. Once you start venturing out further and further away from the main business hubs, the rates start to increase depending on a variety of factors. For example, if you take a location with a higher than normal crime rate and higher unemployment, you will likely see return rates in excess of 15%. However, if you take another location that is in the same distance from San Francisco, but it's in a high income area with extremely low unemployment, you are likely going to see a return rate of 8 to 12%. If you go to a city where the only major employer is about to go bankrupt and they could very well close their factory doors, then return rates would be as much higher due to the extreme risk. Which again brings us to the point of you as an investor knowing what your desired return rate is. Let's go back to the $1 million property example. Let's say you are particularly interested in this property, but because you think some tenants might leave, you don't want to make 10%, you instead demand 12%. Using the same $1 million property example, if you plan on selling this property in 5 years for the same $1 million that you purchased it for, you would have to pay $72,000 less than the original $1 million purchase price to attain your 12% goal. But presume there's a bidding war and you feel this property is just underpriced to draw in your offer. Instead of 10%, you're perfectly comfortable with 8%. Again, using our example, you could pay about $80,000 more than the $1 million list price and still make an 8% return. Another good time to use NPV is when you're calculating future cash flows. Let's say a miracle happened and you won the lottery. They offer you 2 choices. You can either take $100,000 a year for 10 years, or you can take a lump sum of $500,000 right now. Let's plug in all the numbers into a spreadsheet. If you're looking at this from an investor point of view, you basically have to determine if it's more worth it to receive $1 million over a 10-year time period or $500,000 today and double it in the same time frame. The question is, how fast can you make your money grow? If you plan on being conservative and you feel a fair net present value is about 5%, then that $1 million over 10 years today would be worth about $772,000. Looking at our 2 choices, the $100,000 a year or $500,000 right up front, you'd stick with the yearly payments because it's more worth it by $272,000. However, let's say you have big plans on opening your own business. This business is just in high demand and you expect that you can make over 25% return because nobody else carries your product. This pushes the yearly payout value down to just a bit over $357,000. Again, if you're presented with either $100,000 a year over 10 years or a $500,000 chunk of cash, you're going to take the chunk of cash. The reason is because you can make that $500,000 grow to more money than $1 million faster than you can if they just paid you per year. Determining your net present value isn't the easiest thing in the world, nor is it the easiest concept to understand. However, don't confuse the fact that it's a bit tricky to understand the fact that it's one of the most sought after methods by investors in determining what a property is worth to them. Now that's good to know.